Good morning, everyone, and welcome to today's class, which is called Filing Requirements for U.S. Citizens and Residents Living Abroad. Basically, everybody who is required to file an American return, regardless of whether they're a U.S. citizen, a U.S. resident, or an alien of the United States with U.S. source income. All of those people need to file returns with varying filing requirements, and today's class is about figuring out who is required to file when and on what form. And to start the day off, I've got a couple of poll questions up, and these poll questions are actually geared around an actual tax return situation that I ran into last filing season for a person named George. He was a client that came into my office. He had an American tax return that had been prepared for him incorrectly over multiple years by multiple tax preparation firms. It seemed no firm he went into quite understood how to report foreign earnings, so I thought it would be a good way to start off today's class by exploring it. So let's take a look at George's first situation, which is actually at the bottom of the screen here. It says George is a U.S. citizen and resident, and during the year he worked for an employer in the United States and earned $30,000. He also worked in the Canadian tar sands for 6 months of the year under a union contract where he earned $50,000. How much income should he report on his U.S. tax return? So for those of you who are just joining in on our class, it is underway, but what I'd like you to do real quick is tell me how much income George needs to report on his tax return when he's living inside the United States as a resident and a citizen, but also spending a good deal of his time up in Canada. Does he need to report that Canadian income on his American return, or does the fact that he's earning the money in Canada and filing a Canadian tax return have any impact on his U.S. filing requirement? Give you guys a couple of minutes to select the correct answers. Give it your best shot. Okay, good. So we have agreement here. I'll just show you the results of this first poll. Only a couple of people responded, and then I had a couple of texting, and I was kind of egging you on with the right answer anyway. But the truth of the matter is that if you are an American resident, a U.S. citizen, then you need to report worldwide income. Knowing this fact, I frequently run across tax returns, and George is not the first case, and frequently hear news stories and stories coming out of IRS about how people, tax preparers, need to be educated on this very important fact, that you don't just pay tax on income that is earned inside the United States, you pay tax on income that is earned anywhere in the world. Now I'm going to close this poll out and go to the next one. Okay, so George, a U.S. citizen, did not reside in the U.S. at any time during the year and has lived in Canada as a resident since 1990. George earned $80,000 of wages in Canada and received an inheritance of $30,000 in cash from the estate of his uncle, who was a U.S. citizen and resident as well. So how much income should he report on his U.S. tax return? And the answer is $80,000. The income that he earned in Canada is going to be taxed on his U.S. return. He actually has a U.S. filing requirement, even though he hasn't lived in the United States for the past 25 years. And that's something that gets people as well. And it's actually a fairly unique requirement with respect to the United States. I believe Austria is the only other nation in the world that taxes citizens on their worldwide income even when they no longer reside in that country. If you are a citizen of virtually any other country in the world and you leave that country, you emigrate away from that country to live somewhere else, that country stops taxing you on income except income sourced to that nation. So for example, if a Canadian leaves Canada and comes to the United States and lives and works in the United States and holds no Canadian property and has no other Canadian income, then they would not file Canadian returns and they'd be under no obligation to do so. But the reverse situation where you have an American who goes to Canada and lives there permanently for decades continues through all of those decades to have an American filing requirement, even if they haven't been to the United States or had any U.S. source income in those decades. So there is an important piece of information there about filing requirement that a lot of people don't get. So today's class really should be an elementary class. Who needs to file a tax return? And I'm going to show you some very basic information about who is required to file a tax return. And yet, when it comes to say, the IRS Enrolled Agent exam or the Oregon Tax Preparer and Consultant exams, filing requirements are some of the most frequently missed questions. In other words, the finer details of who must file a tax return often escapes professional preparers who've been doing this for years. So we're going to get into the basics today with these concepts. Firstly, the heading here, who must file a return? And we start with this very first sentence that says, you must file a return if you are a citizen or a resident of the United States or a resident of Puerto Rico and you meet the following filing requirements. And essentially, the filing requirements for most individuals are summarized in Table 1, which comes straight out of Pub 17. And if you don't meet any of the requirements shown in Table 1, you may still be required to file a return if you meet the requirements in either Tables 2 or 3. And Table 1, when you look at it, really revolves around your age, your filing status, or rather your marital status, which then determines your filing status, as well as the amount of income that you have. So your filing status, your age, and your income determine your filing requirement. So if you are an individual living in Canada and you are single and your income is $10,000, are you required to file a U.S. tax return? Well, the table here is telling us no. You're not required to file a tax return until your income hits $10,150. So the rule for filing requirement is the same regardless of where you live in the world. It's completely based on your age, your filing status, and your income. Now, if you are age 65 or older, you can increase the filing requirement by the additional standard deduction given to an individual who is age 65 or older. And if you are single, that amount is, I believe, $1,350, and if you are married, it is $1,200. So we'll get into that additional standard deduction right over here. It's actually $1,550 is the difference, and $1,200 if you are filing joint or married filing separate. But for single individuals, it's $1,550. So if we go back up to the table, the difference between $10,150 and $11,700 is that $1,550. All right, now if you move on to the married filing jointly category, you will see that if you are under age 65, both spouses, the filing requirement is $20,300, and that is exactly double that of the filing requirement for single. But there's an interesting one here with married filing separately. Regardless of your age, your filing requirement drops to only $3,950. So if you're filing separately from your spouse and you earn $3,950 or more dollars during the year, you're required to file a return. The end. So it has a very low filing requirement for that particular status. Head of household is a little bit higher than single. You can see here $13,050 is the filing requirement for head of household. And the difference between single and head of household is simply the higher standard deduction amount for head of household. And then finally, we have qualifying widow with dependent child. The filing requirement there is $16,350. You will see it is greater than head of household. It is also greater than single, but it is less than married filing joint. And we're going to take a look at where these computations come from. In other words, how do we arrive at the number that equals the filing requirement? Now, there are a couple of asterisks here to pay attention to. Firstly, if your 65th birthday is January 1, 1950, then you were considered to be age 65 at the end of 2014, even though technically you're age 64 until January of 2015. So that means if you were born on January 1, 1950, then you wouldn't turn 65 until January 1 of 2015. But IRS says you're going to get to claim your age 65 a day before you really turn there. So it's just one of the little weirdisms of IRS rules for a person turning age 65 if their birthday is on New Year's Day. All right, gross income means all income that you received in the form of money, goods, property, and services that are not exempt from tax. So in other words, when we're looking at the type of income to include in this calculation right here, we're looking at income that is generally subjected to tax. And that would not include food stamps. It typically would not include non-taxable Social Security benefits. It would include things that are subject to tax. So if you were filling out your Form 1040 return, they would end up in the column next to the line number. So on line 7 of the Form 1040, you report wage. Wage is a taxable income amount. It goes in the column next to wage. But when you get down to Social Security, you actually have to do a worksheet to determine whether or not any of your benefits are includable in gross income. And if your income's low enough, then you could receive Social Security and not have to include any of that Social Security in the income column. And if that's the case, then that Social Security would not be considered to be part of the gross income test. And then finally it says here, if you did not live with your spouse at the end of 2014 or on the date your spouse died and your gross income was at least $39.50, you must file a return regardless of your age. So let's take a look at the standard deduction. And the reason the standard deduction is important is the standard deduction is what is used to determine your filing requirement. Your personal exemption comes into play as well, but we're going to talk about the standard deduction and the personal exemption together. So your filing requirement is generally tied to a combination of your standard deduction plus your personal exemption. But in the case of a dependent, you throw out the personal exemption and you only have the standard deduction. And would it be only that simple? When you're a dependent, your standard deduction calculation is not simply a number. You have to do a formula to determine what the standard deduction is if you are a dependent. But if you are not a dependent, typically your standard deduction is going to be one of the numbers shown on this table. And each filing status is generally entitled to claim a standard deduction. You claim the standard deduction instead of itemizing your deductions, and you should claim the standard deduction if it is greater than your allowable itemized deductions. But before you figure your standard deduction, you must determine if you're eligible to claim it, because not everyone is entitled to claim their standard deduction. And if you're not allowed to claim your standard deduction, that would be a reason why you can't factor it into your filing requirement. So let's take a look firstly at the standard deduction amounts. Single and married filing separate both have the same standard deduction, $6,200. But the thing is, if you are filing separately from your spouse, if your spouse chooses to itemize, then you must itemize, and therefore your standard deduction, that's why it doesn't factor into your filing requirement. And then head of household is $9,100, qualifying widow $12,400, and qualifying widow and married filing joint are the same amount, $12,400. Now you are not allowed to claim one of those standard deduction amounts and must itemize your deductions if you are married filing a separate return and your spouse itemizes, you are filing a tax return for a short year because of a change in your annual accounting period, or you are a non-resident or a dual status alien for the year, and you are considered a dual status alien if you were both resident and a non-resident alien during the year. Now you are allowed a higher standard deduction if you are age 65 or older and you are considered to be 65 on the day before your 65th birthday. Therefore, you can take a higher standard deduction for 2014 if your 65th birthday is on or before January 1, 2015. You are also allowed a higher standard deduction if you are blind, and you are considered blind or partly blind based on a very specific definition. And the first part is that you cannot see better than 2200 in the better eye after correction with glasses or contact lenses. Well, 2200 means that even after you put your glasses on, that big E, you wouldn't be able to read it. And number two, your field of vision is not more than 20 degrees. In other words, you've got a very narrow focal point, and that's all you can see. So most people don't meet this definition of blind, but if you happen to have a client who does meet the definition of blind, then they get an extra standard deduction. Now, you cannot claim a higher standard deduction for blindness or for being age 65 or older for a dependent that you have. So let's say you are age 30 and you are supporting your age 65-year-old mother. You don't get to claim a higher standard deduction because you're claiming your mother's dependency. Your mother, if she files a return, can claim the higher standard deduction, but not you. And then let's take a look again at these higher standard deduction amounts. Again, they are single or head of household. You get $1,550 as the additional standard deduction, and if you are married filing joint, married filing separate, or qualifying widow, the amount is $1,200. So let's take a look at an example here of how we can use these higher standard deduction amounts to affect filing requirement in the standard deduction. So Max is a single filer, and he is required to file a return if his income is equal to or greater than the combined total of his standard deduction plus his personal exemptions. Well, his standard deduction is $6,200 and his personal exemption is $3,950, so he will be required to file a return if his income is $10,150 or more. Now, if we make Max age 65, then we're going to take $3,950 plus $6,200, we're going to add another $1,550, and that higher number, which is $10,150 plus $1,550, would take us in the table to this number, $11,700, and he would be able to earn that much money before he's required to file a return. All right, so I've already come up to the first point of the day where I'm going to ask you to stop and think for a few minutes about some questions, and I've got them on the screen in front of you. I'm just going to slide it up so that you can read. I'd like you to determine the filing requirement for each of the following taxpayers, And I'm going to put these up as polls so you can go through and determine on each one of these questions whether or not the individual is required to file a return. So you can just type your answer into the box that you see. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry. Click on the link shown here to purchase the manual for this course, enroll in the full course to receive CE credit, or browse our course catalog. All right, class. So let's take a look at the first one. Martha, age 65, is married to Samson, age 70. They had $16,500 of pension income and $5,100 of interest income. Are they required to file a tax return? Question number 2, Jocelyn is married to Mark. Jocelyn lived in Canada all year while working at a university on a 2-year research project. Mark remained in the United States. Jocelyn and Mark will file a joint return together. What is the maximum amount of income they can make before they are required to file a tax return? And question number 3, Peter's wife died in 2013. Peter, age 52, maintains a home for himself and his qualifying child, Zack. Peter's only income for the year was wages totaling $16,050. Is Peter required to file a tax return? All right, so I'm just broadcasting the results for the first exercise, exercise number 1. And in this particular exercise, I've asked you to tell me whether or not Martha and Samson are required to file a tax return. And in order to determine their filing requirement, what you really need to do is add up their income, see how much they have, and then add up all of the components that determine their filing requirement. So Martha is age 65, they're married, and Samson's age 70, they're married. So each of them is going to get an additional $1,200 standard deduction that's going to add to the amount of their filing requirement. And then in addition, they each get $6,200 as the standard deduction, combining to $12,400, and each of them gets $3,950. So if we take $12,400, the standard deduction, then we add $1,200 for each of them, additional standard deduction, we then add $3,950 for each of them, we get a filing requirement of $22,700. The question is, did they earn more than that? And so we add up all of their income, and we get $22,600. Their income is less than their filing requirement, and therefore they are not required to file. So let's move on to the next one. Broadcast results here. And I'm going to have to let you all know that no one got the right answer. Question number 2 baffled you all. The correct answer is actually $3,950, and let's take a look at why. So remember, when we were looking at filing requirements, one of the requirements was that if you were married and lived apart from your spouse at the end of the year, regardless of whether you file a joint return or file separately, then you are going to be required to file if your income exceeds $3,950. So $3,950 is the only correct answer. And then let's move on to the next question in line, exercise number 3 with Peter. So again, Peter, his wife died, and he maintains a home for himself and his qualifying child, Zack. So therefore, we're going to come to the conclusion with this that he qualifies for the qualifying widow with dependent child filing status. So in terms of determining whether or not he's required to file a return, we're going to move over to the filing requirement for an individual who qualifies for the qualifying widow filing status. And the filing requirement, remember, is made up of your standard deduction amount plus your personal exemption. And so the standard deduction for a married person is $12,400. Qualifying widow gets the same standard deduction. And then we add in the personal exemption for Peter. When we do that, we get $16,350. But when you add up the income that he has, you get $16,050. That income is less than his filing requirement, and therefore he is not required to file a tax return. All right. Let's move back to our manual now, and we're going to take a look at the filing requirements for dependents. So the filing requirement rules for dependents are different than for non-dependents. If you are a dependent, you don't get to factor your personal exemption into your filing requirement. You only get to figure it based on your standard deduction. Well, you'd think that would make it easy. I only have to look at one number. That should make it easy. But the problem is that a dependent standard deduction is not the same as the standard deduction of an individual who is not a dependent. So that list of standard deduction amounts, this table of standard deductions, may or may not apply to you if you are a dependent. Let's talk about a situation where the table would apply to you if you are a dependent. If you are a single dependent and the only source of income you have is a job, and that job paid you $5,000 for the year, then your standard deduction is going to be equal to your wages, which still is not $6,200, it's only $5,000. If you are a single dependent and you earned $8,000 for the year working at a job, then your standard deduction would in fact be the same as for an individual who is not a dependent. It would be $6,200. So the confusion with dependents is that their standard deduction is not a fixed number. It is fixed in terms of it maxes out at the same point that the standard deduction does for a non-dependent. But if the dependent's income is less than the standard deduction, then the standard deduction will be different than the maximum number that you see for your filing status. Now, regardless of the regular standard deduction computation, if a dependent is age 65 or older, or if a dependent is blind, their standard deduction will always include the additional amounts you see here. So if you are a married dependent, age 65, then you will be able to figure your standard deduction by adding into it the additional standard deduction for being married filing joint, which here is $1,200, and being age 65 or older. So let's go back to this table. And when we look at the filing requirements for dependents, one of the things we have to take into account is where a dependent is getting their income from. If their income comes from earnings, then their standard deduction will be higher than if their income comes from non-earnings, such as investment income. So let's take a look at what earnings includes. Earned income includes salaries, wages, tips, and professional fees. It also includes taxable scholarship and fellowship grants. And unearned income includes just about any other form of taxable income, such as taxable interest, dividends, capital gains, pensions, annuities, rentals, unemployment compensation, taxable Social Security, and distributions of unearned income from a trust. So let's look at how we figure the standard deduction for a dependent. We're going to just look at a dependent who is not age 65 or older, okay? So under age 65 and not blind, all right? The standard deduction for the average dependent, that means, you know, your child who is 18 years old and still living at home and has a job, what's that kid's standard deduction going to be? Because that's most of the time when we look at dependents, that's what we're looking at. Well, firstly we say, how much is your unearned income? Was your unearned income more than $1,000? Was your earned income more than $6,200? Or your gross income was more than the larger of $1,000, or your earned income was up to $5,850 plus $350. So here's how we have the wording here. You must file a return if any of the following apply. Your unearned income was more than $1,000. So that means you had pension income, you had investment income, and it totaled more than $1,000 for the year. Or you had earned income that was more than $6,200 for the year. Or your gross income was more than the larger of $1,000, or your earned income up to $5,850 plus $350. It's really confusing to understand it, but essentially what it says is you can take your earnings, and if you take the maximum amount of earnings, $5,850, on top of that you can take another $350, and if you add $5,850 and $350, what do you get? You get $6,200. It's essentially saying, let's say Mr. Dependent, or Master Dependent, went out and earned $5,850, and in addition to that, he also had some investment income. You could take $350, add it to $5,850, and the maximum standard deduction that child would qualify for is $6,200. But let's suppose that same child went out, had a job, and earned $2,000. Well, their standard deduction is going to be equal to $2,000 plus $350. So now the standard deduction amount is much less than $6,200. So again, in order to make sense of this, I have some more class illustrations to go through with you, but before we get to those, I wanted to take this formula to the next level, which is to say, okay, I am age 65 or older or blind, then how do I figure my standard deduction for a dependent? Well, it's all of the same rules that you see up here, except no matter what total you arrive at, you're going to add $1,200 for a married dependent or $1,550 for a single dependent. So if you have a single dependent who is age 65 or older, their standard deduction is going to be the minimum of $1,000 plus $1,550, which would give you $2,550. Or it could be more than $2,550 if they have earnings. So if they had a job and earned, say, $2,000 at the job, then you would take the job of $2,000, you would add $350, and then you would add $1,550 on top of that. So let's see if you can make sense of those rules by looking at some illustrations. And I have some in here, and then I'm going to go through these with you to kind of reinforce points, and then I'll have some classwork exercises for you to try on your own. So let's look at the standard deduction for dependents. If you can be claimed as a dependent on another person's tax return, your standard deduction is going to be limited to the greater of $1,000 or your earned income for the year plus $350, but not more than the regular standard deduction amount, which is typically $6,200. Note, however, that if you are a dependent who is age 65 or older or blind, you may increase your standard deduction amount by $1,200 if you were married or $1,550 if you are single. And here is an example. Samantha is age 65 and blind, and she is married. She did not live with her husband at any time during the year and will be filing a separate return. Her spouse will not be itemizing deductions on his separate return. Samantha's only income for the year included $5,000 of non-taxable Social Security and $3,000 of pension. Samantha lived with her daughter Lisa all year, and Lisa provided more than half of Samantha's support and will be claiming Samantha's dependency exemption on her return. Calculate Samantha's minimum standard deduction as follows. We're going to take $1,000 because she has no earned income. Remember that computation? We're taking earned income and adding $350. She has no earned income, so we start with $1,000 instead. So we take the $1,000. We add $1,200 for being 65 or older, and we add another $1,200 for being blind. And when we do that, we get $3,400. Her filing requirement is $3,400. Is she required to file a tax return? Well, she's not going to be required to file a tax return because her Social Security is going to be completely non-taxable. Why is it non-taxable? Even though she's married filing separate, she did not live with her spouse at any time during the year. So she is going to base her calculations for taxability of Social Security on a worksheet. But when we go through that worksheet, we'll determine that none of her Social Security benefits are taxable. So the only taxable income she has is $3,000, and that's less than the filing requirement of $3,400, so she's not required to file a return. Let's look at example number 2. George, age 65, is single. He lived with his girlfriend Jane all year. Jane provided the majority of George's support, and she will be claiming a dependency exemption for him on her return. Calculate George's minimum standard deduction amount as follows. We're going to take $1,000 as the starting point and add into that $1,550. And when we do that, we get $2,250. He will be required to file a return if his income is greater than $2,550. And this is assuming, of course, he has no earned income. If he had earned income, it would be more complicated. And finally, example number 3. Sally, single, is age 18 and blind, and she is a dependent of her parents. Sally earned $2,000 working a part-time job. You're going to calculate her minimum standard deduction as follows. We're going to take that $2,000, add $350, add $1,550, and we get $3,900. Since she earned less than $3,900, she's not required to file a return. All right, so here's the class exercise that I promised you. And what I'd like you to do is read through each of these 4 illustrations here, and I'm going to put up some pods for you to select the correct answer. All right, it looks like we've had as much participation as we're going to get on these answers. There doesn't seem to be a lot of agreement on some of them, and others there seems to be agreement, but are you right on what you agree on? So let's take the first one. Jack, age 15, is a dependent. He had the following sources of income for the year. Wages of $2,100 and interest of $400. And I can see by the responses here that we've got 2 people who think he's not required to file and 1 person who says yes, he is required to file, and the yes makes it. Let's see why. The filing requirement for a dependent is their earned income plus $350. Well, did he earn more than his earned income plus $350? The answer is yes, he did. He earned $2,100 plus $400, whereas filing requirement is $2,100 plus $350. So Jack is required to file a tax return. Illustration number 2. Samantha, age 23 and single, is a full-time student and a dependent. She had the following income for the year. Wages of $600, interest of $400. Is she required to file a return? And the answer is no, she's not. even though her investment income is more than $350, when you take her investment income and her earned income and you add those two numbers together, the total is $1,000. And she's only required to file if the number goes over 1,000. And it is 1,000. It's not more than 1,000. Illustration number 3. Zack, age 65 and single, is a dependent of his son, John. Zack had the following income for the year: wages of $1,200, a pension of $1,600, and interest of $400. So is Zack required to file a tax return? First, we're going to look at the sources of income he has to see, is he allowed an additional standard deduction? He is. He's single, so his additional standard deduction will be $1,550 because he's age 65 or older. So his filing requirement is going to be equal to his earned income of $1,200 plus $1,550 plus $350. When we add all of that up, do we have a number that is greater than his income? And the answer is no. His income is more than his filing requirement. If you take the income amounts here and add them up, you get $1,900, and his standard deduction is less than that. So he's required to file a return. And then finally, we move on to illustration number 4. Martha, age 20 and single, is a dependent of her parents. She had the following income for the year: wages of $5,200 and interest of $350. Is she required to file a return? So the answer is no, she's not required to file a return, and let's see why. Her wages are $5,200, and her wages could actually be as much as $5,850, and she'd still be able to add in that $350. And her wages are $5,200 plus $350 of interest income, so she's not required to file a return. All right, so we've been through Table 1, Table 2. Let's move on to Table number 3 because we're not done. Even if you don't meet the filing requirements shown on Tables 1 or 2, you may still be required to file a return if you meet one of the conditions shown on Table 3. And Table 3 essentially has to do with extra additional taxes that are on top of the regular income tax. And these additional taxes can include the alternative minimum tax, the tax on early distributions from retirement plans, household employment taxes, Social Security and Medicare tax on tips that you received from an employer but did not report, recapture of the first-time homebuyer credit if you are an individual who took that first-time homebuyer credit back in 2008. Even if you have no income, every year until 15 years are up or you sell the house, you need to file a return and report $500 of payback on that first-time homebuyer credit. Write-in taxes, including uncollected Social Security and Medicare tax that you have and need to report, any other recapture taxes. Also, if you received HSA or Archer MSA or Medicare Advantage MSA distributions, you are required to file a return to show that those distributions were spent on qualifying medical, and if they were not spent on qualifying medical, to pay the penalty for having taken them out and not spent them on qualifying medical. Also, if you had net earnings from self-employment of at least $400. So maybe your only income for the year was $10,000 of gross receipts from self-employment. Your total expenses were $6,000, so your total income that you had left was $4,000. That may not seem like a lot of money. It's certainly less than the filing requirement shown in Table A. It's less than the filing requirement for dependents shown in Table B. But because self-employment tax is due on that $4,000, you would still be required to file a return. Also, if you had wages of $108.28 or more from a church or other qualified church-controlled organization that is exempt from employer Social Security and Medicare tax, then you would need to file a return so you can pay your share of tax on that. And finally, a whole new filing requirement that was introduced for the very first time beginning in 2014. If you are an individual who purchased health insurance through the federal marketplace and received an advanced premium tax credit through the marketplace, you are required to file a return. And when you file the return, you have to reconcile the amount of the premium tax credit you received from the marketplace against the amount of premium tax credit you are entitled to. And if you have received too little advanced premium tax credit, you'll actually get a refund of the premium tax credit. And if you received too much advanced premium tax credit, you're going to have to pay some of it back in the form of an added tax. So that is the filing requirements for individuals who are residents or citizens of the United States. Doesn't matter where in the world you live, how long you've lived in another part of the world. In fact, there is a category of American who is very often shocked to determine that they even have a federal filing requirement here in the United States, and that would be children of American citizens that were born overseas. So my husband and I are American citizens, and if we have a child in another country, because we've moved to that other country and we're living there and now we're staying there and we don't ever come back, our child is born in that country and is considered to be a citizen of that country. But a child born to American citizens is automatically an American citizen. They could live in that other country, grow up there their entire lives, have no ties to the United States in any way whatsoever, and still have a filing obligation under U.S. law because they are U.S. citizens. So maybe it doesn't seem fair in that rule, and some people criticize that rule, especially now that we're getting into the IRS crackdown on compliance issues for Americans who have investments overseas. But the bottom line is, if you are an American citizen, you need to file an American tax return based on tables 1, 2, or 3. If you fit into any of the categories requiring filing, you are required to file regardless of your residency. All right, you know what? Let's take 10 minutes. And while we're on our break, I'm going to give you a password. You need to write this down because you're going to need to have this password for when you take the password. This next part of the class is going to be discussing the filing requirements for aliens. And throughout this segment of the class, I will be referring to Publication 519. And you can see the Publication 519 is 61 pages of content plus an index. And therefore, it's a big read. It's a lengthy publication with a lot of important information in it. And my job today is to somehow summarize key aspects of this publication into today's class and give you a rudimentary understanding of the filing requirements for aliens. I can't, in the length of time allowed, begin to really delve into all of the innuendos of everything that you need to know about aliens. But the starting point is that you can determine through proper interview techniques, in other words, asking the right questions so that you can get information from your client, and you determine that your client needs to file Form 1040-NR, this is the publication you're going to go to establish with certainty that they're required to file 1040-NR and are not able to file Form 1040. Or maybe they could file 1040 if they made an election. Now you've got to decide, is it worth making the election to file 1040, or are they better off filing 1040-NR? And then finally, any questions that you might have about elections to file as a full-year resident or not. Dual status residency, what do you do when you've got a dual status resident? Filing status information, and a whole bunch of other information is included in this publication. So I'm going to close out of it now and go back to the manual. As I said, my manual is the best summation I could give you of key elements of that particular publication. And I actually have thrown in a little bit of information from Publication 901, which has to do with tax treaties. So firstly, if you are not a citizen or a resident of the United States for all or part of the year, you must apply different tests to determine if you are required to file a tax return, that is a U.S. tax return. Your status as an alien, that is a resident alien, a non-resident alien, or a dual status alien, determines whether and how much income you need to file on a tax return. So if you file, are you required to file a tax return with the United States? And if so, what income is the United States going to tax? Is it going to tax income earned inside the United States? Is it going to tax your worldwide income? You're going to have to make decisions about that. And the rules used to determine alien status are described in that publication I just showed you, 519. Some of which I'm going to summarize for you here. So let's firstly look at two definitions. The first definition is, what is a resident alien? If you are a resident alien for the entire year, you must file a tax return following the same rules that apply to U.S. citizens. But if you are a non-resident alien, the rules and tax forms that apply to you are different than those that apply to U.S. citizens and residents, and you must file 1040-NR if you do not meet the residency requirements for filing a U.S. resident return and you had taxable American income. There are some important facts you should know about 1040-NR, and they are summarized into 5 key points here. Firstly, you may be required to file Form 1040-NR if you are not a U.S. citizen and you resided in the United States for less than 183 days during the year. Technically, if you are a green card holder, it doesn't matter how many days you are in the United States, you're still considered to be a U.S. resident. But if you're not a green card holder, then one of the key tests we look at is whether or not you are in the country for less than 183 days. Next, we look at if you are required to file Form 1040-NR, you will not be entitled to claim the standard deduction, and you will be required to itemize deductions instead. However, as with everything in the IRS, there's at least one exception to these plain rules, and that is if you are a student or a business apprentice from India, and only India, then you can still be entitled to claim the standard deduction and would not be required to itemize. Number 3, if you are required to file Form 1040-NR, you cannot file a joint return with your spouse unless you are a resident of India. 4, the United States has signed tax treaties with many different countries. And if you are a resident of a foreign country living or working in the United States, you may be affected by a tax treaty between the United States and your home country. Tax treaties between the United States and other countries are outlined in IRS Publication 901, U.S. Tax Treaties. Now, 901 is a summary of tax treaties, but if you want to look into the meat of any particular tax treaty, you just have to do a Google search for U.S.-Sweden Tax Treaty or U.S.-French Tax Treaty or U.S.-China Tax Treaty and read the entire body of the tax treaty if that's what you feel you need to do to establish tax treaty benefits. But most of the benefits, the important ones you need to know about, are summarized in tables included in Publication 901. And number 5, even if you are inside of the United States for more than 183 days, you may still be required to file Form 1040-NR if you are a student, typically holding an F1 or a J1 visa, a teacher holding a J1 visa, a researcher, a temporary worker generally holding an H1 visa, if you are specifically affected by a tax treaty between the United States and your home country. Now, the next category we're looking at is the dual status taxpayer. If you are a resident alien for part of the tax year and a non-resident alien for the rest of the year, you are a dual status taxpayer. And different rules apply for each part of the year, but generally you will be required to file 2 short year tax returns as follows. For the part of the year that you are a non-resident, you will report your U.S. source income on Form 1040-NR. Well, if you had no U.S. source income during your period of non-residency, you actually would have no filing requirement for your period of non-residency. But if you did have U.S. source income, then you would need to file for that U.S. source income, and you would do so on Form 1040-NR. Now, from the point in time that you become a U.S. resident, you must file a return reporting your worldwide income, and you would do that on Form 1040, and there are procedures about how you do so. Firstly, no standard deduction. You're going to be required to itemize your deductions. You're going to need to write dual status taxpayer on the front of the return to let the IRS know that you are dual status and you're only reporting income for the point where residency began. And let me kind of give you an example about how these dual status situations come up and what you do with them. I've had a few clients in the last couple of tax seasons that have been dual status, and it's refreshing. I've been doing tax returns professionally since 1993. I've been doing it a long time. And there's never been a season where I saw virtually no non-resident alien returns coming through my doors, except the Great Recession that we had between 2008 and about 2011. I saw almost no non-resident alien returns coming across my desk. In other words, 1040-NR, I kind of forgot what it looked like, got fuzzy on some of the rules for it. But prior to 2008, we saw a lot of 1040-NR returns coming through our doors, and since 2012, we're starting to see them coming again, and in a way I feel like we're 1040-NR central here at Pacific Northwest Tax Service in terms of the number of them that are coming through the door. There's a lot of them. So every time you're dealing with a non-resident or a person who is a dual status resident, you're having to make some determinations about whether or not they are a full year non-resident in the United States and need to file 1040-NR for the entire year, or whether they're dual status and they might be able to report or file as a dual status resident for part of the year. And how do you break that income up? And where do you find that dividing line of when residency began and so forth? Now, I'll give you a couple of examples that I've dealt with this filing season. I had a British fellow who married an American gal, and they did so here in the United States, actually in Georgia, right around summertime of 2014 they got married. Now, for the period of time that they were married, of course, he is a U.S. resident. So they came across and got married in August 2014, and he came in under a fiancé visa and is essentially now getting his green card complete and so forth. And so he is considered to be a U.S. resident from the period of time he arrived in the United States. And as a U.S. resident, he needs to report his worldwide income. Now, for the first part of the year, he lived in England, and he actually had pretty good income. And so the question is, does he want to make an election to file as a full-year resident of the United States and file a joint return with his wife, or does he want to file separately from his wife and do 1040 NR for the part of the year he was a non-resident, and 1040 dual status for the period of the year that he was a resident. And there's a lot of factors that are going to go into this. At the same time I have the British client, this year I actually had another client from India. And he and his wife married in India, and she did not actually come to the United States until January of 2015. So he is a full-year resident of the United States. He went to India, they got married, and she did not leave India and arrive in the United States until January of 2015. So what about her income? What about his filing status? Well, his filing status is going to be married filing separate because he was married on the last day of the year, unless the two of them elect to file a joint return. And if they elect to file a joint return, then they will need to report their worldwide income. And is that in their best interest? Well, actually, it all depends. There's a lot of things that factor into these decisions, and a lot of it has to do with the level of income that an individual has. Now, it happens to be the case that my client from India, she worked for a big American financial institution there, American Bank, and earned about $110,000 US while living in India. And her husband has a similar wage, around $150,000, that he earned in the United States and in India working for his American employer. And when you combine their incomes together, you get $250,000. And you could go, well, wait a minute, she can exclude her foreign income under the foreign earned income exclusion, so filing joint could benefit them. But actually, it didn't benefit them at all. No matter how I ran the numbers, they ended up being better off filing separately. And as soon as I filed them separately, she had no filing requirement at all because she wasn't a resident of the United States during the year. She had no American source income. So we just left her off the return completely, and he filed separately. Now, for the British client who came to the United States in August and got married, things were actually quite a bit different. For him, if he elected to report his worldwide income and file a joint return with his newlywed wife, he was going to be able to exclude his British income under the foreign earned income exclusion. And by filing a joint return, they would get the benefit of the higher standard deduction for married filing joint and the higher exemption amounts. And actually, once he came to the United States, he had almost no income. So his income in the United States was very, very small. So by her filing a joint return with him, she actually came out ahead, and the refund was much larger. So those are things to factor in. You have to look at all of the circumstances involved with those clients and then determine whether or not they should file a tax return. Now, let's look back at that British guy, because this is a lot of information I'm throwing at you. But let's look at the British guy and say, okay, what if he could file a joint return with his wife and report his worldwide income, but for some reason they've decided they're not going to file jointly? And actually, that was the case with my client. They decided not to file jointly. And the reason they decided not to file jointly, and this is happening quite a bit, completely unrelated, but I'll just throw it in there to show you what's going through the mind of people these days. When you have student loans, the payback schedule you have on those student loans is based on your income. And if you file a joint return, it could be that the student loan payments are going to go up because the income on the joint return is higher. And so I've had multiple clients this tax season who have elected to file jointly, pay additional tax by have elected to file separately and pay the additional tax owed with married filing separate returns, simply so that they can keep the payment schedule of their student loans lower. And in fact, that is what happened with my British client. He could have made an election to report his worldwide income, file a joint return, and saved the both of them tax liability, and they would have come out ahead. But they decided to file separately. So what happened with the separate situation? Well, for the period of time that he was a non-resident of the United States, he had no U.S. income and was not required to file Form 1040-NR. And for the period of time he was a resident of the United States, he had only American income. So he filed a dual status return 1040. He claimed this itemized deductions. And because he itemized on his married filing separate return, she also had to itemize on her married filing separate return. So those are some of the things you have to factor in with this dual status taxpayer. It's a lot of information to take into account, and I've been really explaining some of the rules about dual status filers and married filers to you in my examples, but we're going to actually go and look at some written terminology so we can see how the IRS is actually putting this into language, and then my interpretation of that language. Test. Aragorn, A-R-A-G-O-R-N. All right, so we are coming back from our break. In order to determine whether or not you need to file 1040-NR or Form 1040, you have to determine your residency. And if you are not a citizen of the United States, you determine your residency before you can determine your filing requirement. And you are a resident alien of the United States for tax purposes if you meet either the green card test or the substantial presence test for calendar year 2014, which is, of course, January 1 through December 31. Now, even if you don't meet either of these tests, you may be able to choose to be treated as a U.S. resident for part of the year. And you would refer to Publication 519, go to page 7, and look at the first year choice under dual status aliens to determine if you qualify to make the choice to be treated as a dual status alien for the year. Then we have the green card test. You are a lawful permanent resident of the United States if at any time you have been given the privilege, according to immigration laws, of residing permanently in the United States as an immigrant. You generally have this status if the U.S. Citizenship and Immigration Service has issued you an alien registration card known as a green card. And if any of you have seen a green card, you'll know that they're actually pink. So I don't know why they're called a green card, but they're pink. You continue to have a resident status under this test unless the status is taken away from you or it is administratively or judicially determined to have been abandoned. And you should refer to page 3 of Publication 519 for more about termination or abandonment of residency. If you decide to terminate your residency, you may have to pay an expatriate tax. I don't deal with that expatriate tax returns too often, but I have a client talking to me about expatriation right now. And that's a whole other tax return, whole other topic. Substantial presence test. You will be considered a U.S. resident for tax purposes if you meet the substantial presence test for calendar year 2014. And to meet this test, you must be physically present in the United States on at least 31 days during 2014, plus 183 days during the 3-year period that includes 2014, 2013, 2012. And when you do this particular formula, you will count all the days that you were physically present in 14, plus 1/3 of the days that you were present in 2013, plus 1/6 of the days that you were present in 2012. I don't make these illustrations up. This one comes from Publication 519. You were physically present in the United States for 120 days in each of the years 2012, 2013, and 2014. To determine if you meet the substantial presence test for 2014, you would count all 120 days of presence in 2014. You would count 1/3 of the days of 2013, which is 40, and you would count 1/6 of the days of presence in 2012, which is 20. Because the total of the 3-year period is 183 days, you are not considered to be a resident under the substantial presence test for 2014. So what is the United States? Well, the United States includes the contiguous lower 48 states plus Alaska and Hawaii and, of course, the District of Columbia. It also includes the territorial waters of the United States and certain subbed and subsoil areas outside of the United States off the shores. The United States does not include U.S. possessions and territories or U.S. airspace. So how do you count days of presence in the United States? You'd think it would be simple. If you're in the country, you count the day. But of course, it's not that simple. There's other rules to factor in. You are treated as a present in the United States on any day that you are physically present in the country at any time during the day. However, there are exceptions to this rule. Do not count the days or the following days as presence in the United States for the substantial presence test. Firstly, days that you commute to work in the United States from a residence in Canada or Mexico if you regularly commute to the United States from Canada or Mexico. Or days that you are in the United States for less than 24 hours where you are in transit from 2 places outside of the United States. Or days you are in the United States as a crew member of a foreign vessel. Or days you are unable to leave the United States because of a medical condition that arose while you were in the United States. And finally, any days that you are an exempt individual. Okay, what does that mean, exempt individual? So you're supposed to count all the days you're physically in the country And most of the exceptions seem kind of self-evident. You don't have to worry about those too often. But then we get down to this category, don't count as a day in the United States any day that you were an exempt individual. So what is an exempt individual? Well, an exempt individual is an individual who is described in one of the following categories. Firstly, an individual temporarily present in the United States as a foreign government-related individual under the A or G visa category, or a teacher or trainee temporarily present in the United States under a J or Q visa, or a student temporarily present in the United States under an FJ, M, or Q visa, or a professional athlete temporarily in the United States to compete in a charitable sports event. Now, the specific rules for each of these 4 categories, again, are described in Publication 519. You would go to Chapter 4 for more. But let's talk a little bit about what it means if you are an exempt individual. And I don't have an image of Form 1040-NR on the screen for you, but I'm going to explain to you that page 5 of 1040-NR, down at the bottom, it has a space where you enter the number of days of physical presence in the United States. And that question is, how many days were you physically present in the United States? Well, if I was present in the United States in 2014 for 100 days, I'm supposed to write 100 days on the line for 2014. But if I was in the United States for 100 days and I had a J visa or an F visa as a student, I would actually enter 0 days because I would be an exempt individual. So even though I'm here, I'm not. And that's what that definition is specifically getting at, is you're trying to determine whether or not you meet the substantial presence test. And you determine this test by counting only those days that are days that count and are not exempt days. Closer connection to a foreign country. So even if you meet the substantial presence test, you can be treated as a non-resident alien if you are present in the United States for less than 183 days during the year, you maintain a tax home in a foreign country during the year, and you have a closer connection during the year to one foreign country in which you have a tax home than you are to the United States. Now, you can have 2 tax homes outside of the United States, or a closer connection to 2 foreign countries than you do to the United States, and still be able to qualify under this closer connection to a foreign country rule, but there are different rules that apply, more specific rules that apply, and you have to read about those. Married dual status alien can be choose to be a resident alien for the year. So in both the illustrations I gave you earlier about dual status aliens, I had individuals who were actually foreign nationals who had married American residents or green card holders or citizens. And there's a special rule that applies to those individuals. You have to be married to take advantage of this particular rule. If you are single, it doesn't work for you. If you are a dual status alien, you can choose to be treated as a U.S. resident for the entire year if all of the following apply. You were a non-resident alien at the beginning of the year. You were a resident alien or U.S. citizen at the end of the year. You are married to a U.S. citizen or resident alien at the end of the year, and your spouse joins you in making the decision. This includes situations in which both you and your spouse were non-resident aliens at the beginning of the year, and both of you are resident aliens at the end of the year. So what that's saying is, let's just suppose my husband and I are citizens and residents of Australia, and we arrive in the United States on August 30th. Well, based on the time of arrival in the United States, we don't meet the substantial presence test. We're not here more than 183 days before the year is out. But because we're married, we could actually make an election to treat ourselves as if we were full-year residents and report our worldwide income. Whether or not it's in our best interest to do so is going to be a matter of math calculations and formulas and so forth, and it may be that they are better off making a decision to be treated as U.S. residents for the entire year, or it could be that that's not in their best interest, and we should file 1040-NR for their first year of residency or dual status for the first year of residency, whichever way we decide to go. Now, if you make this choice, the following rules apply. You and your spouse are treated as U.S. residents for the entire year for income tax purposes, and you and your spouse will be taxed on your worldwide income. You and your spouse must file a joint return for the year of the choice. Neither you nor your spouse can make this choice for any later year, even if you are separated, divorced, or remarried. And finally, the special instructions and restrictions for dual status taxpayers described in Chapter 6 of Publication 519 would not apply to you. Now, a married non-resident alien can choose to be treated as a resident alien. If you are a full-year non-resident or a dual-status resident who is married to a U.S. citizen or resident at the end of the year, you and your spouse can choose to file as a U.S. resident. If you previously made that choice and it is still in effect, you do not need to make the choice explained here. So where would that fall into our equation? Now, in the earlier illustration here, we're talking about individuals who were non-residents at the beginning of the year, and at some point during the year, they became residents of the United States. In the second election feature here, we're looking at an individual who is either a U.S. citizen or resident on the last day of the year, and they're married to someone who is not a resident at any time during the year. Can they still make the election? And the answer is yes, they can. And I have done this many times over the years. This is not an unusual thing either. You can have an American resident, and I've run across this, interestingly, quite often in the past, not recently, but with clients from Africa. They might have come to the United States as refugees, and they've left their spouses behind in the foreign nation. And they may be trying to get them out, or maybe they're not trying to get them out, but they have spouses in their homeland. So they themselves are considered to be residents of the United States. They have green cards. They may be going through immigration procedures on their spouses, maybe not, don't know. But they have a spouse in this foreign nation, and very often that spouse has little or no income. So here you've got this person in the United States who is married, and they've got two choices: married filing joint or married filing separate, unless they somehow qualify for head of household filing status. So that individual maybe would like to file a joint return with their foreign national spouse so that they can have the advantage of the higher standard deduction amount, claim their spouse's personal exemption as well. To make that choice, obviously there needs to be an application attached for a Form W-7 to get an identification number for that spouse. But assuming that is possible and is being done, then they can make that choice to be treated as a U.S. resident. And as I said, I've done that a number of times over the years. To make the choice, you should attach a statement that is signed by both spouses to your joint return for the year of choice. The statement must contain the following information: a declaration that you both qualify to make the choice and that you choose to be treated as U.S. residents for the entire year, and the name, address, and taxpayer identification number of each spouse. If one spouse died, include the name and address of the person who makes the choice for the deceased spouse. And you generally can make this choice when you file your return. However, you can also make the choice by filing an amended return, as long as you do it within that 3-year limit from the due date. Effect on tax treaty. If you make this choice, you and your spouse are treated for income tax purposes as residents for the entire year, and neither you nor your spouse can claim any tax treaty benefits that are available to non-residents. Ending the choice: once the choice is made to be treated as a resident, it applies to all later years unless suspended, and you must meet certain tests described on page 8 of Pub 519. So those are the rules for married filers, and they actually seem fairly straightforward. And you're going to make a decision to file as a full-year resident or a dual status resident or none of the above. But if you are single, it is harder. Now, if you are single or if you're filing married filing separately, there can be a first-year choice to be treated as a U.S. resident, but it would be under the dual status rules, not under the full-year rules. If you do not meet either the green card test or the substantial presence test for 2013 or 14, and you did not choose to be treated as a resident for part of 2013, but you meet the substantial presence test for 2015, which is a whole new year, you can choose to be treated as a U.S. resident for part of 2014. So what is this saying? Well, 2013, perhaps you could have made a choice to be treated as a dual status taxpayer, but you didn't. And if you had, then you would have been a resident for 2014. But based on the substantial presence test, when you add up the number of days of presence in the United States for 2014, you don't meet the substantial presence test. But 2015, you are going to meet the substantial presence test, or perhaps you've already met the substantial presence test in 2015. If that's the case, then you can be treated as a dual status resident. And your residency is going to begin based on these determinations that I'm describing here. And they're horribly confusing. So again, if you don't meet either the green card test or the substantial presence test for 2013 or 14, and you did not choose to be treated as a resident for part of 13, but you meet the substantial presence test for 2015, you can choose to be treated as a U.S. resident for part of 14. And to make this choice, you must be present in the United States for at least 31 days in a row in 2014 and be present in the United States for at least 75% of the number of days beginning with the first day of the 31-day period and ending on the last day of 2014. For purposes of the 75% requirement, you can treat up to 5 days of absence from the United States as days of presence in the United States. When counting the days of presence in either 1 or 2 above, do not count the days that you were in the United States under any of the exceptions discussed earlier under days of presence. So apply the following rules to determine the beginning of your residency. If you make a first-year choice, your residency starting date for 2014 is the first day of the earliest 31-day period that you use to qualify for the choice, and you are treated as a U.S. resident for the rest of the year. Now, this could be pretty clear-cut. Let's suppose you arrive in the United States on August 31. And you're going to easily meet the requirement for being treated as a U.S. resident, either because you've been given the appropriate kind of visa or a green card, or because by the time you're filing your 2014 return, you've met the physical presence test for 2015. There's all kinds of factors that go into that. But you determine what that day is that you started your physical presence in the United States, where you were here consistently for 31 days in a row. And if that day happens to be August 31 that your physical presence starts, you count forward 31 days and you were here that whole time, then you were considered to be a resident of the United States beginning on August 31. It could be that you arrive in the country, you spend 20 days here, you leave the country, you come back, you spend another 31 days here, you leave the country, you come back and spend another 20 days here. What do you do in situations like that? And that's what these instructions are really attempting to button down for you. If you are present for more than one 31-day period and you satisfy condition 2 above for each of those periods, then your residency starting date is the first day of the first 31-day period. If you are present for more than one 31-day period but you satisfy condition 2 above, only for a later 31-day period, then your residency starting date is the first day of the second or later 31-day period. And here is an example. Juan de Silva is a citizen of the Philippines, and he came to the United States for the first time on November 1st, 2014, and was here on 31 consecutive days from November 1 through December 1 of 2014. He then returned to the Philippines on December 1 and returned to the United States on December 17, 2014, where he stayed in the United States the rest of the year. During 2015, Juan was a resident of the United States under the substantial presence test. Juan can make the first-year choice for 2014 because he was in the United States in 2014 for a period of 31 days in a row, November 1 through December 1. And for at least 75% of the days following and including the first day of his 31-day period, a total of 46 total days, he was in the country. So that equals 75.4%. So if Juan makes a first-year choice, his residency starting date will be November 1. Let's take the same example as above, except that Juan was also absent from the United States on December 24, 25, 29, 30, and 31. He can make the first-year choice for 2014 because up to 5 days of absence are considered to be days of presence for purposes of that 75% requirement. You can see that determining that dual status residency can have a bit of a formula involved to it, and it is contingent upon the number of days you're physically present in the United States, and then it also has to do with whether or not you are considered to be a resident in 2015. So let's look at the non-resident alien filing requirements. Now, you've pretty much established that your client is going to be filing 1040-NR because they're not going to be filing 1040. In other words, if they're dual status and they have U.S. income, they would file 1040-NR for the period before they became a resident in the United States. And if they were a full-year non-resident of the United States but had U.S. income, they're going to be filing 1040-NR. So how do you determine if they need to file 1040-NR, aside from the fact that determining they're not eligible for 1040? Well, a non-resident alien who's required to file an income tax return should use Form 1040-NR, or if they qualify, they can use the simpler version, 1040-NR-EZ. Quite frankly, I never fill out any NR-EZ. I just go straight to the long form. I just find it easier to fill out the long form than the short form. Now, if you are any of the following, you must file a return. You are a non-resident alien individual who is engaged or considered to be engaged in a business in the United States during 2014. And you must file even if your income did not include income from a trade or business conducted in the United States. you have no income from U.S. sources, or your income is exempt from tax. So essentially, if you are engaged in a business in the United States, even if that business had no income, you're still required to file. And if it did have income, you're going to report the income and pay tax on it. Or you are a non-resident alien not engaged in trade or business in the United States with U.S. income on which the tax liability was not satisfied by the withholding of tax at the source. A good example of what this is referring to is individuals who reside permanently outside of the United States. They don't work in the United States. They might travel here, but essentially their income is earned outside of the United States. But they might have U.S. investment income. Maybe they've got a Smith Barney account here, a brokerage account with $1 million in it in American investments, and it's generating American income. That income is going to be subjected to U.S. tax. And there's actually a particular form that those investment or brokerage firms are supposed to use to report to the federal government the amount of income that you had and the amount of withholding they've done on that income. And that form is Form 1042. So if the client is issued a Form 1042, 1042 has already determined the amount of tax that is due on that U.S. source income. And if that U.S. source income has had that appropriate tax withholding done on it and the 1042 is issued, then no filing requirement applies. But if there is income for which 1042 did not withhold tax as it should have, then the filing requirement would apply. Also, a representative or agent responsible for filing the return of an individual described above, or a fiduciary for a non-resident alien estate. Those would cause the 1040-NR to need to be filed. Now, you may also file if you want to claim a refund of over-withheld tax that was paid or overpaid tax, or to claim the benefit of any deductions or credits. For example, if you have no U.S. business activity but have income from real property that you choose to treat as effectively connected income, you must timely file a true and accurate return to take allowable deductions against that income. There are some exceptions again. You do not need to file Form 1040-NR if you meet either of the following conditions. Your only U.S. trade or business was performance of personal services and your wages were less than $39.50, and you had no other need to file a return to claim a refund of overwithheld taxes to satisfy the additional withholding at source or to claim income exempt or partly exempt by treaty. So what this is saying is, let's say you come to the United States and you work here and your income is $3,000 for the year. You're not a U.S. citizen, you're not a U.S. resident. Whether or not the income was legally earned is really not the point. The point is, how much income did you earn working for an employer? And if that amount is less than your personal exemption amount, then you don't need to file. The reason for this is that although 1040-NR does not give you a standard deduction, it does give you a personal exemption. So if you have earned income, your personal exemption becomes your filing requirement, but it's only related to earned income and not to other forms of income. And finally, number 2, if you were a non-resident alien student, teacher, or trainee who was temporarily present in the United States under an FJ, M, or Q visa and you had no income that is subject to tax, such as wages, tips, scholarship, and fellowship grants, dividends, etc., then you would not be required to file a return. But if you do have income that is subject to tax, then you would still be required to. And I actually do have a number of people contact me each year who are here in the United States, especially under F visas. Students come to the United States to attend college, and typically during their college experience, they will be allowed to legally get a job to do an apprenticeship program. And it could be for any U.S.-based employer. Sometimes they work directly for the university or college they're attending, but probably even more often they leave campus and get a job somewhere else, and their visa will allow for that. They'll get a special work permit that permits that during that time. And if they do that, then they would be required to file a return, but they might be or might not be eligible for certain tax benefits based on treaty. And every country has its own treaty, and so what applies to one student will not necessarily apply to another student who comes from another country. So let's talk about these effects of treaties. The United States has income tax treaties with a number of foreign countries, and under these treaties, residents, not necessarily citizens of foreign countries, are taxed at a reduced rate or are exempt from U.S. income taxes on certain items of income that they receive from sources inside the United States. And these reduced rates and exemptions vary among countries and specific items of income. If there is no treaty between the United States and your country, you must pay tax on income in the same way and at the same rates that are shown in the instructions for Form 1040-NR. What is the effect of U.S. tax treaties on states? In other words, states of the United States, such as Oregon, California. Do those states recognize those tax treaties? Well, typically they are required to, and so they're going to follow the federal rules. However, you can't have a blanket statement for any state, and so when you are preparing a state tax return, you should actually read the instructions for that state on terms of how it treats income based on treaty. Treaty provisions. Tax treaties reduce U.S. taxes of residents of foreign countries, and with certain exceptions, they do not reduce U.S. taxes of U.S. citizens or residents. U.S. citizens and residents are subject to U.S. income tax on their worldwide income. There is a reciprocity agreement between the United States and tax treaty nations. So if the United States has a tax treaty with England, and you go to Publication 901 to look up the provisions of the tax treaty between the United States and England, Publication 901 essentially shows you the treaty provisions available to a national of the United Kingdom or a resident of the United Kingdom working in the United States. And that same treaty provision is going to apply to an American working in the United Kingdom. However, if you are an American working in the United Kingdom, the treaty benefits apply to you on the English side, how England will tax your income. It does not apply to you on how America will tax your income. So when you're looking at the tax treaty benefits described in Publication 901, you're looking at examples or rules of how the United States may or may not give treaty benefits to an individual who is in the United States filing Form 1040-NR and is a resident of another country. If you are an American who goes to a foreign country and works, tax treaty provisions apply to you only on the foreign country's tax return, not on the U.S. tax return. So let me give you an example. I had a client in the last few years who was kind of confused by this issue. He actually went to Germany on a Fulbright grant, some kind of special grant where he's being paid $50,000 through this grant procedure to work in Germany on a special research project. And when you read the tax treaty benefit with Germany, it appears that it's tax exempt. Well, that's right. It's tax exempt in that Germany cannot tax him on that income. But he's not tax exempt under American law because he's still a U.S. citizen or resident, and he will be taxed on his worldwide income. But if we had it in the reverse, where we have a German who comes to the United States on one of these Fulbright grants and is receiving money from this entity that is not an American entity, and possibly even if it was, you have to look at the treaty provisions with Germany. At any rate, that person comes to the United States and works here under the terms of a particular treaty provision, then it could be that the United States would not be allowed to tax any of that income. They would probably still need to file Form 1040-NR to claim the treaty benefit, but the United States would not be able to tax them. So how do you know if someone has a treaty benefit impacting them or not? Again, we go back to Publication 901. So treaty provisions, generally, as I've already explained, are reciprocal in that they apply to both nations. They are summarized in Publication 901. And IRS says that if you take a position that any U.S. tax is overruled or otherwise reduced by a tax treaty provision, you generally must disclose that provision on Form 8833 and attach it to your return. A penalty applies if you are taking advantage of that provision and don't attach the form. Now, if you are filing Form 1040-NR and you are taking advantage of one of the treaties shown here, you need to indicate that treaty and the amount of income that is exempt from tax on Form 1040-NR. And 1040-NR will ask you for the treaty provision that applies. You go to the tables, and I've just randomly selected a particular table from Publication 901. It goes on extensively, page after page after page, for various nations. I just grabbed Australia and Austria here. So you can see in column 1 it says, what is the name of the country? Column 2 is the code. That would be the treaty code provision. And then we have the treaty article provision over in the far column. We then have the purpose or the category of personal services that are being provided. And depending on the type of personal service you provide, there's going to be limits that apply to any benefit that you might be able to receive. For example, here it says independent personal services. If you are here in the United States for 183 days or less, and you are working essentially for any contractor, and typically that means self-employed, then there's no limit on the amount of income that you can exclude from taxation by the United States. So if you come into the United States essentially self-employed in business for yourself, you generate some income while you're here, you're going to be able to exclude all that income from U.S. source if you are a resident of Australia. But if you are a dependent, meaning you're working for an employer, and you come to the United States and you're here for 183 days or less, you can still exclude all of your income, but only if your employer is foreign resident. That means a company or employer that is not an American employer. If you come to the United States and you work for an American employer, well, it's not exempt. There's no treaty provision that applies to you. You're going to have to pay tax on that income. So that's what these tables are talking about. So we've been talking about filing requirements for residents of the United States and filing requirements for non-residents of the United States, and also wanted to get into some better descriptions of the definitions of the type of income. Because for both residents and non-residents of the United States, your filing requirement can be dependent upon the amount and type of income that you have. So earned income, we discussed these a little bit earlier, but we'll refresh your mind on them again. Earned income is money or property you receive for services you perform. Examples include wages, commissions, tips, farming. Unearned income includes income from investments such as interest, dividends, capital gains, rental property, and royalties. But it also includes other types of income such as unemployment, benefits, alimony, pensions, and any other income you receive that is not compensation for performing personal services. Unearned taxable income is used to determine your filing requirement. If you are a dependent, unearned income can cause you to have a filing requirement at a lower level of income than is the case with earned income. But remember, when you're looking at filing requirements, you do not include non-taxable income. Non-taxable income is income that is exempt from taxation under the law, and examples include child support, VA benefits, various military allowances, workers' compensation, gifts, life insurance proceeds, and state and municipal bond interest. Bear in mind that these are federally exempt only and may be taxable at the state level. Non-taxable income does not affect your filing requirement. Accounting methods and periods. Typically, when you file a tax return, usually your first tax return, you have to choose an accounting method. Virtually every taxpayer in the United States is a cash method filer. The accrual method of filing is typically only chosen by businesses, but under the cash method of accounting, you report income as you receive it. You report expenses in the year that you pay them. If income is earned in one year but not received until the next year, you would only report it in the year you receive it. Versus the accrual method of accounting, which typically is used by businesses. Not all businesses, but large businesses are required to use it. Under the accrual method of accounting, you report income when you have earned it and it is due and payable to you, even if you haven't received it. And you are allowed to deduct expenses when they are owed and payable, even if you haven't paid them. Filing deadlines. April 15th is the filing deadline for a timely filed U.S. tax return. But if April 15th falls on a Saturday, Sunday, or legal holiday, the filing deadline is delayed until the next business day. But bear in mind, Emancipation Day throws itself in there. Emancipation Day is recognized in the District of Columbia, and as such, IRS shuts down on Emancipation Day. And therefore, if Emancipation Day falls on the Monday following the filing deadline, then the filing deadline will push out until Tuesday. And this actually happens quite often. We haven't had it for the last couple of years. The last time it did happen was in 2012, and in that year, April 15th fell on a Sunday, and Emancipation Day fell on Monday the 16th. Emancipation Day was therefore honored on the 16th, which was the Monday, and tax filing deadline moved to April 17th, which was the Tuesday. For 2015, the filing deadline will be April 15 of 2016, which is a Friday, and then the year after that we're going to be dealing with these Emancipation Days and the filing deadline being extended out again. Extensions, it is common belief that if you file for an extension that you can get additional time to pay, and lots of people file extensions because they can't afford to pay, but the reality is that if you owe money and can't afford to pay it, you should file your return on time and worry about how you're going to pay the money later, and the IRS has installment agreement requests that you can use. So your tax bill is due April 15th or the next business day if April 15th falls on a weekend or holiday, regardless of whether or not you file for an extension. And if you are going to file for an extension, you do it with Form 4868. And then when you look at Form 4868, you will see it asks you to figure your tax liability for the year, then to enter your total tax payments for the year, and to determine if you have a balance due. And if you do, you're supposed to send it in with the extension. Now, if you are an individual who is an American citizen or resident and you are residing overseas, the filing deadline is 2 months later. Rather than having a filing deadline of April 15th, the filing deadline moves to June 15th. So how do you determine if you are eligible for that? Firstly, we have outside of the United States or serving in a combat zone. Those are two situations where you're considered to be outside of the United States, and you are allowed that 2-month automatic extension until June 15 if you are a U.S. citizen or a resident, and on April 15th, you are either living outside of the U.S. and Puerto Rico, and your main place of business is also outside of the United States or Puerto Rico, or you are in the military or naval service on duty outside the U.S. and Puerto Rico. To get an automatic extension because you are outside of the United States, you must attach a written statement to your return explaining the reason, A or B above, that qualifies you for the exclusion. You should still pay any tax you owe by April 15th, or you will be charged interest, but not a penalty from that date until the tax is paid. Who is an individual serving in a combat zone? Well, you are considered to be serving in a combat zone if you are a member of the armed forces, Red Cross personnel, or an accredited correspondent, or a civilian under the direction of the armed forces, and you were serving in the Persian Gulf area, the Kosovo area, or the Afghanistan area. The extension period gives you another 180 days to file if you are in a combat zone. So the deadline for filing a return and paying tax due and filing a claim for a refund is extended by at least 183 days or 180 days after the later of the last day you served in a combat zone or the last day you were last confined to a hospital for injury from service in the combat zone. The extension period includes at least 180 days plus an additional amount of time equal to the amount of time you had left to file your return prior to April 15th before you entered the combat zone, which is up to 3.5 months if you entered the combat zone on January 1st. Penalties and interest for late filing. An extension of time to file is not an extension of time to pay, and you should estimate how much money you owe when you file your return and mail the balance due with the extension. If you don't do that, either you file late or you pay late, you're going to be subjected to some penalties. Firstly, we have a failure to file penalty, and it is assessed when your tax return is filed after the due date plus extensions, and the usual penalty is 5% for each month or a part of a month that a return is late, but not more than 25%, and it is based on the tax not paid by the due date without regard to extensions. So filing late is bad business. 5% penalty per month. After 5 months, you've maxed out at 25% penalty. So if you didn't file on time and you owed $1,000 and now it's 5 months past the filing deadline, you can automatically add $250, and now your starting point is $1,250 instead of $1,000. Now, if the return is more than 60 days late, the minimum penalty is $135 or 100% of the unpaid tax. If your failure to file is due to fraud, the late payment penalty is 15% for each month rather than just 5% that your return is late, and the maximum failure to file penalty due to fraud is 75%. Late payment tax, a failure to pay penalty of 0.5% is assessed for each month or part of a month after the due date that the tax is not paid. So if you file late and pay late, you're going to pay a failure to file penalty of 5% per month, plus a failure to pay penalty of an additional 0.5% per month. You are not required to pay this penalty if you file an extension and paid at least 90% of your actual tax bill when you filed for the extension, as long as you pay the balance when you file. The monthly rate for the failure to pay penalty is reduced to 0.25% if you have an installment agreement in effect. If a notice of intent to levy is issued, the rate will increase to 1% at the start of the first month that the money is not paid. And finally, the penalty cannot be more than 25% of your unpaid tax. You will not have to pay the penalty if you can show that you had good reason for not paying your tax on time. Combined penalties, if you file and pay late, the failure to file penalty of 5% or 15% is reduced by the failure to pay penalty. However, if you file your return more than 60 days after the due date, the minimum penalty is the smaller of $135 or 100% of the unpaid tax. So failure to pay, failure to file, best to be avoided. Speaking of tax, let's talk briefly about how to calculate your tax. If you've been doing tax returns for a long time, you're used to having your computer do the computing for you. Maybe you've never actually hand computed tax before. The hand computations of tax are very worthwhile. Firstly, they explain to you really so that you can explain to your customers how a tax bill is assessed against them based on their income, the type of income they have, and also some special taxes. And in particular, I wanted to show situations where your computer may be doing a calculation and you're not quite understanding where it's coming from. You will need to have manual calculations of taxes to really see how these things work, but your computer is doing it in the background for you. And your tax will be different than the tax figured on the tax tables or the tax rate schedules if you have income from qualified dividends or capital gains, investment income that you are reporting for your child. The parent's election to report the child's interest or dividend income on the parent's return will cause the parent's tax to be different than the tables. But in addition, if you have a child filing a return and they are dependent of their parents and they have investment income, they're going to have to use separate computations to figure the tax they owe on their investment income. And finally, if you are claiming the foreign earned income exclusion, the tax tables simply don't work for you. You have to go through a fairly complex worksheet to figure the tax that you owe when you claim the foreign earned income exclusion. But if things are fairly straightforward to you and you don't have any of those circumstances that apply, you can go to the tax tables as long as your income is less than $100,000. And this is a cutout from Publication 17. And we have an example here. Your taxable income is shown for head of household. Your taxable income is $69,250. You would figure your tax by going to $69,250 in this column and then going across to the head of household column, and you would determine that the tax is $11,731. But if your income is over $100,000, then you have to use the tax computation worksheets, and here is what they look like. You have a separate worksheet for each filing status. And I have an illustration here of a married filing joint filer who has $250,380 of taxable income. And we come across and find where they fall on the table. You will see at that level of income they fall into the 33% tax bracket, but not all of the income is taxed at 33%. Some of the income will be taxed at 25%, some will be taxed at 28%, some will be taxed at the lower rates as well. So all of the lower rates are factored into this formula. You start with the taxable income and multiply that by 33%. You get $82,625. You then subtract out $24,095, which is the tax on all of the income that falls into the lower tax brackets, and you are left with the net tax for the year, which is $58,529. Now, in addition to the income tax calculations I've just described, you may owe additional taxes. These are all of the situations where an additional tax could be owed: self-employment tax, additional Medicare tax, net investment tax. And you can see that these coincide with the filing requirements shown in Table 3. One tax I didn't include on here, it's an addition for this year, is the advanced premium tax credit. We need to add that in. And finally, which form do I use? Typically, Form 1040 is the form I like to work from because every form of income and credit and deduction can be reported on Form 1040. And as soon as you move over to 1040EZ or 1040A, which a lot of individuals do, lines are missing, and it's not uncommon for a tax preparer or a taxpayer to think, well, there's no line for this income, I guess I don't have to report it. For example, the wage line on a tax return, you might read the instruction, it'll say add up your W-2s, and if you don't have a W-2 because you worked in Canada, you might think I don't need to report that income on there. So I like to start with the 1040 and use that as my base point. You can see that on Form 1040 we have lines for all of the different forms of income, and if we get down to line 21 and you have a form of income that wasn't listed above, you hand type in or describe the type of income you're reporting. We then have a number of different adjustments to income that can be claimed. And moving on to the next page of the Form 1040, you have your itemized deductions or your standard deduction, your exemption deduction, the alternative minimum tax, and a whole list of credits. We have other taxes that you might need to pay, and then payments from various sources. Now, if you're filing 1040A, that form is much simpler to file than 1040. However, the form has restrictions on the types of income, credits, and deductions that can be reported on it. For example, you can report wages, pensions, interest, dividends, and unemployment, but you can't report something from something pretty common like stock sales, self-employment, or rental property. They just can't be entered on that form. And 1040EZ is the simplest form of all, but it is also the form that I see gets the people into the most trouble, especially dependents. They get the 1040EZ, fill it out, claim their own dependency exemption because they're not paying attention, and then they file it and cause problems for their parents who would otherwise be able to claim them. But really on 1040EZ, you must use the filing status of married filing joint or single. And that form can only be used to report wages, unemployment, and interest. Any other form of income, and you need to file the longer forms. Form 1040-PR stands for Puerto Rico. And actually, 1040-PR is a Spanish language form, and it is used to compute the self-employment tax on self-employment earnings from people living in Puerto Rico. And there is an English language equivalent of that form. It is 1040-SS. All the years I've been doing tax returns, I've really only ever had one of these come into my office, but I have dealt with it. 1040-NR, this is the form that is filed by people who are not residents or citizens of the United States but have income that is taxed by the United States. And 1040-NREZ is a simpler version of Form 1040-NR. As I said, I never bother with it. I just use the long form. It's not that complicated if you ask me. Then we have the taxpayer identification number that we're going to talk about a little bit. Taxpayer identification number, when you file a U.S. tax return, if you want to claim an exemption for your spouse or a dependent, or even yourself, you're going to need to have an identification number. But not everyone is eligible for a Social Security number. So we're going to talk about what happens when you don't have a Social Security number. So every individual who files a U.S. tax return is required to have a tax ID number, and for most filers that is their Social Security number, but there are certain individuals who are not eligible for a Social Security number and will need to apply for an ITIN, and that includes people like undocumented workers who have income from performing services inside the United States. Essentially, they're here illegally, don't have work permits, they're not eligible for a Social Security number, but they have worked. And under U.S. law, if you have income from the United States, you are required to pay tax, even if you aren't doing it legally. And so those individuals need to apply for an ITIN so that they can report their income. Also, if you have dependents that are living outside of the United States, either in Canada or Mexico, who are eligible to be claimed as a dependent on a U.S. tax return but are not eligible to receive a Social Security number, then you need to get an ITIN for them. Or a married taxpayer who enters the U.S. under a valid work visa and is filing a married filing joint return and will need to obtain an ITIN for his or her spouse if that spouse is not eligible to receive a Social Security number. Foreign buyers and sellers of U.S. real property interests are required to have ITINs to request reduced tax withholding when they are disposing or selling a property interest that requires withholding. So I have actually a client like that right now. Sold a rental property here in Portland. They're a resident of Argentina. They're going to have to file a U.S. tax return. They don't have a Social Security number, so we're going to have to apply for one. Adoption taxpayer ID number. If you are in the process of adopting an American child, not a foreign child, but an American child, and you are not able to get that child's Social Security number during the adoption process, you can apply for an ITIN while that adoption is pending finalization. Individual taxpayer identification number. If you're not eligible for a Social Security number and you need to apply for an ITIN, you need to complete Form W7. We do at least 2 or 3 of these a tax season in our office, depending on your firm's volume and the type of clients you're getting in. You may do none of these, or you may do many more of them, but we see them at least 3-4 times every tax season coming into our firm. And when you file Form W7, there's some pretty specific rules about how you do it. One of the rules is that you need to attach the W7 to the tax return. You also need to attach original copies of the documentation proving identity and foreign status. The problem with this rule is that the United States notoriously loses these documents all the time. So if you send an original passport to the IRS and they lose it, it may cost you a few $100s to get it replaced. And meanwhile, you can't travel. So the IRS does have an exception to sending original documents, and that is if you can get the original issuing agency to issue a certified copy. So I've done this a few times now. Last year, I brought in new clients who are from Australia. They have children here in the United States, and they've decided to invest in real estate here in Oregon. And so they knew that they needed a taxpayer identification number, and they also knew that they needed to have original copies of their passports attached, but they were in the United States traveling on them, so how can we do that? So what I had them do, they were going to be traveling to Chicago, and there is an Australian embassy or a consulate in Chicago. So while they were in Chicago, they went into that consulate. The consulate created a certified copy of their Australian passport, and they then sent me that certified copy. We attached it to the federal return along with a copy of the W-7. Miraculously, the IRS didn't lose it, and they got their ITIN numbers. So that's an example of people who are not residents applying for numbers. It could be that you're applying for a number because you have a dependent who is in Canada or Mexico. It could be that you need an ITIN because you are an illegal alien here in the United States. Whatever the reason is, you have to follow the procedures, which is typically either the original document attached to Form W-7, attached to an original return, and mailed in to the IRS. And these are the types of documentation that are acceptable listed in this table. And here is the application form itself. I'd be careful about how you fill the form out, because if there are any errors on it, it will probably be rejected. And most recently, I had a client who filed an ITIN application attached to her tax return for both her parents who were in Mexico. IRS issued an ITIN that they were able to get their hands on for one parent, but not the other parent. And because we didn't know enough to attach a power of attorney to the tax return, when we've tried to call the IRS to find out the status on the other parent, the IRS won't talk to either me or to the client, because the ITIN application is for the parent who lives in Mexico, doesn't have a phone number, and doesn't speak English. So there's no way we can resolve the issue of this parent because we didn't think ahead of time to have that parent sign a power of attorney. So if you are doing an application for a person who is residing outside of the United States, it's best to have them sign a power of attorney so that you are able to contact the IRS on their behalf. Filing methods. Obviously, there are different ways to file a tax return. We typically have paper or electronic. If you are a professional tax preparer and you prepare, or your firm prepares 11 returns or more during the year, you are required to electronically file. And the only exception to requirement to electronically file every return is if you have a return that cannot be electronically filed, and there are a number of reasons why it couldn't be electronically filed. It's 1040-NR. That's only fileable as a paper return. Or you're attaching Form W-7, that has to go paper. Or you have one of the small number of forms out there that simply cannot be e-filed. Or finally, your client just simply refuses to electronically file. Those are all reasons why you would not be required to file a particular return. But this overall requirement does not apply to individuals who do not meet the definition of a paid tax return preparer. And these include people who are providing tax assistance under the Volunteer Income Tax Assistance Program, also called VITA, or a person who merely prepares a return for his or her employer, or a person who prepares a return as a fiduciary of anyone else. If you do electronically file, you need to attach Form 8879 to the return. One of the beauties of Form 8879 that is different than the full 1040 form if you're mailing in a paper return is it is possible to have clients who live outside of the United States or just outside of your area sign this form and either fax it to you or e-file it to you, and then you can use that to e-file the return. But if you are filing a paper return for a client, the IRS only accepts the original signature, so paper returns are really much more arduous to file. For example, my Australian clients, they're filing 1040-NR, and I can't e-file them, and they're in Australia. So what do? Do I print the package, assemble it all, ship it to them in Australia, have them sign it and ship it all the way back to the United States? Do I email them the form and say sign it and then print all the forms and assemble them yourself and then mail them back to me so I can sign them? What do? Well, when I am dealing with anyone who can e-file, I e-file. That's the first rule. But if they can't e-file, then I find the best way to provide good customer service to my clients is to email them the pages that they have to sign. So on 1040-NR, it would be page 2. And I'll say, sign page 2 of Form 1040-NR. Sign page 2 of the Oregon Form 40. Mail both of those back to me. I will then sign them myself. I'll print and attach all of the other forms and mail them for you from here. So that is one way of dealing with paper returns. But oddly enough, while the IRS accepts only original signatures on paper tax returns, it will allow an e-file service provider to file a return electronically even when the only signature they have is a replica of a signature, either faxed or emailed. Now, if you are filing an electronic return, but that return needs to have attached to it certain documents that cannot go electronically, you need to file Form 8453 and send that to the IRS with the forms attached that could not go out electronically. So, for example, if you have a client who is going through a change in accounting method during the year, and you prepared 3115, at this point I don't believe 3115 can go electronically with an individual return, and so you would attach the 3115 to the return by mailing it separately from the return to IRS on Form 8453. Another example is Form 8949 for sales and other dispositions of assets. It could be that your client has provided to you all the equivalent pages of 8949 and you don't want to have to enter them all into your computer. IRS allows those supplementary pages of 8949 to go in with 8453. Also, the release or revocation to release of a claim for exemption on a child for divorced or separated parents. So there's quite a few things that this form is used for. And we're now on to decedents. The filing requirements for dead people are the same as for living people. That's what decedents is all about. And since they're subjected to the same filing requirements, you're going to look at the tables 1, 2, and 3. And if a person who died met any of the filing requirements in tables 1, 2, or 3, then they're required to file a return. But you only look at the filing requirements of table 1, 2, and 3 for the period of time they were alive. Once they're dead, any income that is earned through property that they hold or from pension plans and so forth is income in respect of a decedent and belongs on the estate or fiduciary return. So let's look at the key points to learn about decedents. Firstly, they are subject to the same filing requirements as living persons, and it is the duty of a personal representative to file the decedent's final return. In some situations, it is the surviving spouse who will file that final return. Actually, in many cases, it is. When filing a final return, include only income earned and expenses paid prior to death. Income earned and expenses paid after death is income in respect of a decedent, and income in respect of a decedent belongs on the estate return, which is a 1041 return. Decedent's name and date of death should be written across the top of the tax return. A personal representative may revoke a joint election made by a surviving spouse. So if the surviving spouse decides to file a joint return with her deceased spouse, the personal representative can come along later and revoke that and force an amendment to married filing separate. But if they do that, it has to be done within 1 year of the date of the return, including extensions. Generally, a person who is filing a return for a decedent and that return shows a refund will have to attach Form 1310. However, if the person claiming the refund is a surviving spouse or is a court-appointed or certified personal rep, then 1310 does not need to be attached. And finally, a surviving spouse who is filing a joint return should write filing as surviving spouse in the signature section of the return. All right, so that is it. We have concluded today's class. Thank you for participating. Those of you who are live students, you're done. If you're a webcast or webinar student, you have no assignments other than the password test. You just need to go and take it. But if you are a self-paced student, there are a series of assignments that you do need to complete to get course credit. And those assignments are available to webinar students if they choose to take them, but they're not mandatory. If you're self-paced, they are mandatory. So thank you, everyone, for participating in today's class. It was great seeing you, and I'll see you in a few minutes when we start our next class today. See you soon. Bye-bye. Password number 2 is TANG, T-A-N-G, TANG. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.